In this presentation, we will take a look at a partnership situation where a partner is going to leave the partnership, be paid by the partnership at the point of leaving with an amount that will be equal to the capital account for that partner. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So here's going to be our information. We've got the trial balance here, the assets in green, liabilities in orange, then the capital accounts. It's nice to be able to see the trial balance. It's just a very short trial balance here to give us an example of this process. Note, however, that when we look at the trial balance, we want to make sure that we have a post-closing trial balance, meaning we have no revenue and expense accounts. Those have been closed out to the capital accounts, thereby giving us the proper amounts in the capital account. So we basically have our accounting equation here where we have assets minus the liabilities equals the capital accounts. And we're going to say that M here is the one who is going to leave. So we're going to leave the partnership and M is going to be the one leaving. This will be the ideal situation in which we're going to actually pay M the exact amount of the capital, which makes it nice and easy for us on the accounting side of things. Not probably the way things typically will happen in real life. It'll typically be something paid out probably more or less. Why? Because typically we'll have things like fixed assets on the books that will not be on a fair market value method. And therefore, that's one reason that we might have a negotiations between the partners as to what would be a good payout for a partner to leave the partnership, and it may or may not be equal to the capital account. We may have to revalue, in other words, the asset and liabilities of the company and think about what the actual value of that partner share is. So if it was a perfect world and the assets were equal to the liabilities and those were the fair market values and there were no other factors involved, then we might say, okay, we're going to pay off the exact amount that the capital account is on the books for. And again, if everything was perfectly market value, then that might be a reasonable case, but there typically would be revaluation. So how would we do this then? We're going to debit the capital account because it's on the books for $151,200. This partner is leaving the partnership, so we will debit it to make that account go down. Then we will credit the cash account to pay off the cash. So cash has a debit balance. We will do the opposite thing to it, a credit, to make it go down. Posting this out then, cash starts at $550,000. It's going to go down by the $151,200 we're going to pay out to the partner leaving us with $398,800. Then the capital account here, it's going to be M's capital, starting at $151,200. It's going to go down in the debit direction, $151,200 to 0. And that, of course, will leave us with just the two remaining partners here. Our accounting equation still in balance, our trial balance still in balance. In other words, assets minus the liabilities still equaling the equity. Also note that net income is not affected here. So although cash went out, it's not going to be like an expense to the partnership. In other words, the partnership paid cash to the partner for the partner to leave, but that cash is not, of course, an expense. It's not going to be reducing net income. For more accounting information and accounting courses, visit our website at accountinginstruction.info.